They told you silver was just another commodity. They told you the rally was over. They told you to sell at $62 and take your profits. They lied. Not a small lie. Not a white lie. This is a lie so massive, so deliberate, so criminally negligent that when the truth finally explodes into the mainstream, the entire global financial system will shake. While you were watching the ticker on Friday, December 19th, while the algorithms were painting charts and the talking heads were calling tops, something happened in the vaults of the world's largest banks that changes everything. Something happened that makes the $67 record close look like a joke. Something happened that proves this rally isn't speculation. It's survival. J.P. Morgan Chase, one of the most powerful financial institutions on planet Earth, just got caught in a trap. A trap so perfectly designed, so precisely timed, so mathematically inescapable, that by early January 2026, they will face a choice. Pay any price for physical silver, or default on the largest precious metals lease in modern history. We're talking about 4,000 metric tons of silver. That's 128.6 million troy ounces, borrowed from the Industrial and Commercial Bank of China in early October 2025. A 3-month emergency lease to cover a shortage so severe it paralyzed the London bullion market. The return date? Early January. 11 days from right now. But here's the problem. Here's the trap. Here's why this might be the single most important story in the commodity markets today. On January 1st, 2026, China implements export restrictions on silver. New licenses required, new quotas enforced. The country that controls 60 to 70% of global silver exports is about to turn off the tap. At the exact same moment, the London Bullion Market Association implements a new rule, a rule buried in technical updates, a rule that makes Russian and certain Asian silver bars illiquid in the global market. Non-Roman lettering banned from serial numbers. Effective January 1st, so let me connect the dots for you. J. P. Morgan borrowed 128 million ounces in October. They must return it in January. But the two largest sources of replacement, silver, China, and Russia, will be either restricted or delisted starting January 1st. Where does that silver come from? Where does one of the most sophisticated banks in the world find 128 million ounces when the vaults are already empty? The COMEX, the largest silver futures exchange in North America, just experienced the most violent physical delivery surge in 25 years. In the first 4 trading days of December alone, over 60% of registered silver inventories were claimed for delivery, 60% gone in 4 days. As of December 19th, 62.47 million ounces have been demanded for physical delivery this month. The registered inventory sits at 130 million ounces. Do you see the math? Do you see the problem? If J.P. Morgan needs to buy back 128 million ounces and the entire COMEX registered supply is only 130 million, where does it come from? Who loses? Who defaults? India, the world's largest silver consumer, imported 1,715 metric tons in October alone. That's 55 million ounces in 1 month. 7% of annual global mine production in one country in 1 month. Refiners are sold out. Physical premiums hit 17% above spot. For the first time in history, India's largest precious metals refiner reported zero silver inventory. They're calling it the silver black hole, a gravitational force so powerful it's pulling metal from every vault on Earth. And they're seeking another 2,000 tons before year end. Think about that. India alone could absorb another 64 million ounces in the next 10 days. Add that to J.P. Morgan's lease obligation. Add that to industrial demand. Add that to investment flows. Then ask yourself, is there enough silver on this planet to satisfy all the claims? This video is for educational and entertainment purposes only. This is not financial advice. Silver markets are extremely volatile. Never invest more than you can afford to lose. Always consult a licensed financial advisor before making any investment decisions. Do your own research. The global silver market ran a deficit of 215 million ounces in 2025. That's the 5th consecutive year of deficits. We've been draining above-ground stocks for half a decade. Mine production is flat at 830 million ounces. Recycling can't keep up. And now just as the vaults hit critical levels, just as India goes into full accumulation mode, just as China locks down exports, J.P. Morgan has to return the largest emergency lease in modern history. This isn't a coincidence. This is a checkmate. This is the moment when paper contracts meet physical reality. And physical reality doesn't negotiate. On Friday, December 19th, 2025, silver futures settled at $67.38 per troy ounce, an all-time record high, not adjusted for inflation, not in nominal terms, an actual verified undeniable all-time high. The previous record was $49.45 in April 2011. The Hunt brothers' peak in 1980 hit $50 before the crash. We just shattered both. But here's what they're not telling you. This isn't the top, this is the starting line. Silver has more than doubled in the last 12 months, from around $30 in December 2024 to $67 today, a 127% gain. It outperformed gold. It outperformed equities. It outperformed every major commodity. And it did so while fighting suppression, while battling shorts, while overcoming decades of paper manipulation. The ratio of open interest to registered COMEX silver hit 244%. That means for every ounce of physical silver available for delivery, there are nearly 2.5 paper claims. This is a Ponzi scheme, and it's about to collapse. Price discovery. You've heard this term before, but do you understand what it really means? For decades, silver traded in a controlled range, $20 to $30, occasionally spiking, always crashing back. The narrative was always the same. Silver is industrial. Silver is a byproduct. Silver has no monetary value. All lies. The truth is, silver was suppressed because it threatened the dollar system. If silver, the people's money, the constitutional money, ever broke free and found its true value, confidence in fiat currency would evaporate, so they capped it. They shorted it. They flooded the market with paper contracts. But you can't print physics. You can't short a solar panel. You can't algorithmically trade your way out of a supply deficit. And now, the suppression has failed. The price is discovering its true value in real time. No more artificial ceilings. No more coordinated smashes. Just pure supply and demand. And demand is infinite, while supply is finite. Let me walk you through what happened in October 2025. India exploded. Festive season demand during Diwali combined with industrial stockpiling for solar panel production. Orders flooded into the London bullion market. One single order, reportedly over 1,000 tons, hit the LBMA. Delivery timelines extended from the standard 2 days to 60 days, 60 days. The market couldn't deliver. Lease rates, the cost to borrow physical silver, spiked above 40%. 40% annual interest just to borrow silver for a few months. That's not a normal market. That's a market in crisis. Liquidity vanished. Dealers panicked. And according to sources within bullion circles, J.P. Morgan turned to the Industrial and Commercial Bank of China for an emergency lease, 4,000 tons, 128.6 million ounces. Terms, 3 months, return to early. January 2026. Now, let's be clear. This lease has not been officially confirmed by J.P. Morgan or ICBC. There are no press releases, no regulatory filings, no mainstream media coverage. The information comes from bullion market insiders, independent analysts, and leaked discussions on trading platforms. Some dismiss it as rumor, but the circumstantial evidence is overwhelming. The timing matches the October shortage. The volume matches COMEX and LBMA stress indicators. The delivery flows from China to India through Hong Kong match customs data. 644 tons of silver flowed from China to India via Hong Kong in October alone. And J.P. Morgan's activity in the COMEX vaults tells a story. They shifted millions of ounces between registered and eligible categories in late 2025. They stopped receiving delivery notices in December. They are managing something. Whether it's this specific lease or a similar supply crisis, the behavior is undeniable. Something big is happening. And it involves J.P. Morgan, China, and a January deadline. So what happens if the lease is real? What happens if J.P. Morgan can't source 128 million ounces by early January? Let's game this out. Option 1, they buy from the open market. But the COMEX only has 130 million ounces registered. If they pull even half of their obligation from COMEX, the exchange faces a delivery crisis. Shorts get squeezed. Prices spike. Other longs demand delivery. The system breaks. Option 2, they source from China. But China implements export restrictions on January 1st. Will Beijing grant an exception to J.P. Morgan, an American bank, during a trade war to export 128 million ounces? Unlikely. Option 3, they source from other global suppliers. But the LBMA just changed the rules. Starting January 1st, bars with non-Roman lettering, including Cyrillic from Russian refiners, are no longer compliant for new serial numbers and markings. Russian bars, which represent 5 to 10% of global good delivery supply, become harder to move in London markets. Asian bars, already tight due to China's restrictions, become even scarcer. So where does the silver come from? Option 4, they default. They pay a cash settlement instead of physical delivery, but default carries consequences, reputation damage, counterparty risk, legal battles, and it confirms to the market that physical silver is unavailable at any price. If J.P. Morgan, with all their resources, all their vault access, all their trading power, cannot deliver physical silver, what does that say about the entire paper silver market? It says it's a fraud. It says the claims exceed the metal. It says the price is fake. And when that realization hits the broader market, the scramble for physical silver will make October look like a warm-up. Option 5, they negotiate an extension. They ask ICBC for more time. But ICBC is a Chinese state bank. Why would they grant mercy? China is accumulating hard assets. China is weaponizing supply chains. An extension might come with brutal terms, higher rates, political concessions, or maybe no extension at all. Maybe China wants JP Morgan to squirm. Let's talk about the COMEX vault drain, because this is where theory meets reality. The COMEX reports daily inventory levels. Registered silver is available for delivery. Eligible silver is stored but not designated for contracts. In late November 2025, registered silver stood at 113 million ounces. Then December hit. On December 1st, delivery notices started pouring in. By the end of day 4, December 4th, 47.6 million ounces had been claimed, 60% of registered inventory, in 4 days. Traders were stunned. Analysts called it an emergency. By December 8th, over 50 million ounces demanded. By December 11th, 55 million. By December 16th, 58 million. By December 19th, 62.47 million ounces, all accepted, no rejections. The metal moved out of registered vaults and into the hands of buyers demanding physical. As of today, December 21st, registered silver sits at approximately 130 million ounces. It's stabilized slightly because some eligible silver was converted to registered to meet demand. But the trend is clear. The vaults are bleeding, and the month isn't over. Here's the terrifying part. December is traditionally a low delivery month. Most traders roll contracts forward. They don't stand for delivery in December. But this year, they did. Why? Because they don't trust the paper. They want the metal. And if this is happening in a slow month, what happens in March? March is a major delivery month. Open interest in March 2026. Silver futures is already elevated. If even a fraction of those longs demand delivery, if the vault drain continues at this pace, the COMEX will run out of registered silver by spring. And when that happens, the exchange faces a choice: force cash settlements and admit the system is broken, or halt trading and face lawsuits. Either way, confidence in paper silver dies, and the price of physical silver goes parabolic. India's role in this cannot be overstated. India imported 1,715 metric tons of silver in October 2025 alone. To put that in perspective, global mine production is roughly 850 million ounces per year. That's about 70 million ounces per month. India imported 55 million ounces in October, nearly 80% of 1 month's global production. One country, 1 month. And they didn't stop. November saw another 1,600 tons. December is projected at over 1,000 tons. Total 2025 imports could exceed 9,000 tons. That's 289 million ounces from one country. This is unprecedented. India has always been a major silver buyer, but 2025 shattered all records. Why? Cultural demand during festivals, solar panel production for renewable energy targets, investment demand as the rupee weakens and inflation rises, and most importantly, sovereign accumulation. In a landmark move, India formalized silver as collateral for bank loans in 2025. This is the first remonetization of silver in India since 1873. Banks now accept silver as security for credit. This policy change unleashed a tidal wave of buying. Households, businesses, and institutions began hoarding silver, knowing it now has formal financial utility. Estimates suggest that if just 10% of eligible participants pledge silver as collateral, annual demand could rise by 100 to 200 million ounces. This isn't speculation. This is sovereign policy driving structural demand, and it's happening right as global supplies hit record lows. India's demand is a black hole. It pulls silver in, and the silver doesn't come back out. It's consumed, hoarded, or locked in vaults. Recycling rates in India are minimal. Cultural attachment to silver means families hold it for generations. So every ounce that enters India effectively leaves the global market, and India wants another 2,000 tons before year end. That's 64 million more ounces in 10 days. China's export restrictions add another layer of pressure. On November 3rd, 2025, China announced that starting January 1st, 2026, silver exports will require quotas and licenses for the years 2026 and 2027. The stated reason is to secure domestic supply for technology and solar sectors. The real reason is strategic. China understands that silver is a critical material for the global energy transition. Solar panels require silver. Electronics require silver. Electric vehicles require silver. Whoever controls silver supply controls the future of technology. By restricting exports, China gains leverage over Western economies desperate for green energy infrastructure. It also protects domestic industries from foreign competition. And it sends a message. We own the supply chain. You need us more than we need you. China produces roughly 100 million ounces of silver annually and exports a significant portion. If those exports drop by 20 or 30%, the global market loses 20 to 30 million ounces of annual supply. That's a massive hole in an already deficit market. And it's not just mine production. China also refines and processes silver from other countries. If those refining services are restricted, global liquidity tightens even further. The timing is suspicious. China announces restrictions in early November. JP Morgan allegedly leases silver from a Chinese bank in October. The lease expires in January, right when restrictions take effect. Coincidence? Or coordination? Some analysts believe China deliberately set a trap. Lend the silver, let the Americans rely on it, then cut off replacement supply. Force them to pay any price or default. If that's the strategy, it's brilliant, and it's working. The LBMA rule change is the third piece of the trap. On December 16, 2025, the London Bullion Market Association announced updates to its good delivery rules, effective January 1, 2026. Buried in the technical updates is a critical change. Non-Roman lettering is now prohibited in serial numbers, date codes, and fineness markings on silver bars. Non-Roman lettering includes Cyrillic, Chinese characters, and other scripts. The stated reason is standardization and anti-counterfeiting. The real impact is to make Russian and some Asian bars harder to trade in London markets. Russian refiners, already suspended since March 2022 due to sanctions, used Cyrillic markings. If sanctions lift, they'd need to redesign bars to comply with the new rules. That takes time and money. Chinese refiners mostly use numeric serials, so they're less affected, but combined with export restrictions, Chinese supply is still constrained. The result is a de facto reduction in globally acceptable silver supply. Bars that were liquid last year might not be liquid in 2026. This forces buyers to pay premiums for compliant bars from Western or approved refiners. And guess who holds large quantities of compliant bars? JP Morgan. So let's put it all together. JP Morgan allegedly borrowed 128 million ounces in October. They must return it in January. Starting January 1st, China restricts exports. Starting January 1st, LBMA tightens bar standards. Starting December 1st, COMEX vaults drained 62 million ounces in 1 month. India wants another 64 million ounces before year end. The global market is already in a 215 million ounce deficit, and silver just hit an all-time high of $67. This is a perfect storm. 3 regulatory changes, 2 demand shocks, and 1 expiring lease, all converging in the first week of January 2026. If you believe in coincidences, stop watching now. If you believe in strategic traps, keep listening, because this is about to get much worse. Let me give you the math of extinction. Total global silver supply in 2025, approximately 1.01 billion ounces. That includes 830 million ounces from mining and 180 million from recycling. Total demand, approximately 1.225 billion ounces. Industrial demand, 600 million. Jewelry and silverware, 200 million. Investment, 250 million. Photography, medical, and other, $175 million. Deficit, 215 million ounces. That deficit is covered by drawdowns from above-ground inventories, but those inventories are nearly gone. COMEX registered silver, 130 million ounces. LBMA vaults, estimated at 300 to 400 million ounces, but much of it is allocated or held by institutions. Shanghai Futures Exchange, less than 50 million ounces. ETFs globally, around 600 million ounces, but those are investor-owned. They can't be rated for industrial use without tanking the funds. So realistically, the free-floating, unallocated, available for delivery physical silver in the world is probably less than 300 million ounces. Maybe less than 200 million. Now add the January demands. JP Morgan lease, 128 million ounces. India's remaining year-end imports, 64 million ounces. COMEX deliveries if the trend continues, potentially another 20 to 30 million ounces in late December and early January. That's over 200 million ounces of demand hitting the market in a 3-week window. The available supply is 200 to 300 million ounces total. Do you see the problem? There is no slack. There is no buffer. If even one of these demand sources exceeds expectations, the market breaks. If JP Morgan buys aggressively, COMEX inventories collapse. If India accelerates, premiums explode. If China fully enforces export restrictions, global liquidity vanishes. And all of this is happening while the price is already at all-time highs. Imagine what happens when the real panic starts. Some of you are thinking they'll just recycle more silver. They'll incentivize scrap collection. They'll pull silver from old electronics, old jewelry, old industrial waste. Wrong. Silver recycling is brutally inefficient. Gold is recycled at 90% because it's concentrated in jewelry and coins. Silver is dispersed. A fraction of a gram in a phone, a thin film in a solar panel, a trace amount in a missile. The cost to extract that silver exceeds its value at current prices. Even at $67 per ounce, most electronic waste isn't economical to recycle. You'd need silver above 100, maybe 150, before large-scale urban mining becomes viable. And even then, it takes years to build the infrastructure. Recycling facilities, collection networks, processing plants. By the time recycling catches up, the shortage will have already caused a price explosion. And here's the kicker. The silver going into products today won't be recycled for 10 to 15 years. A solar panel installed in 2025 won't be scrapped until 2040. An electric vehicle battery won't be recycled until 2035. The silver is being locked away in long-duration assets. It's functionally removed from supply for a generation. This isn't a temporary squeeze. This is a structural multi-decade deficit. Can miners produce more? No, not quickly. Silver is mostly a byproduct. 72% of silver comes from mines primarily digging for copper, lead, zinc, or gold. Silver is a bonus. So even if silver prices triple, copper miners don't suddenly dig faster. Their economics are based on copper, not silver. Primary silver mines exist, but they're rare and small, and it takes 10 to 15 years to bring a new mine from discovery to production. Permitting, financing, construction, ramp up. Even if we discovered a massive silver deposit tomorrow, it wouldn't produce an ounce until 2035 or later. The market needs silver now. Tesla needs it now. India needs it now. J.P. Morgan needs it now. Geology doesn't care. You can't print a silver mine. You can't legislate ore into existence. The supply is what it is, and it's not enough. Let's talk about what you should do. Because knowledge without action is useless. The December dip to $62 was a gift. The Friday close at 67 is still a gift. If the Lease story is true, if the triple trap is real, if January brings the chaos we expect, 67 will look absurdly cheap by February. But you have to act smart. You have to understand the landscape. There are 3 ways to play this: physical metal, mining stocks, and timing. Let's go through each. Physical metal is your insurance policy. This is not a trade. This is wealth preservation. In an industrial squeeze, the rules change. For years, dealers have pushed collectibles. Limited edition coins, graded slabs, proof sets, numismatics with premiums of 30, 40, 50% over spot. Forget all of that. In a supply crisis, industrial buyers don't care about rarity. They care about weight. They need raw silver to melt into solar paste or solder or electrical contacts. If spot hits $100, your collectible coin might trade at $105, while a generic bar trades at $100. You paid a 50% premium for 5% upside. That's a bad deal. The strategy is simple. Buy the cheapest, most recognizable, most liquid silver you can find. Government-minted coins like American Silver Eagles, Canadian Maples, or Austrian Philharmonics. Or buy bars. 10-ounce bars, 100-ounce bars from recognized refiners like Sunshine, Asahi, or Royal Canadian Mint. Your goal is to accumulate the maximum number of ounces before the shortage becomes mainstream news. Forget the fancy stuff, buy weight. But here's the harsh reality. Physical silver is already hard to find. Premiums are elevated. Dealers are sold out of popular products. If you go to a major online dealer right now, you'll see out of stock on half the inventory. The items in stock have premiums of $5 to $10 over spot. That's 15% on a $67 spot price. In some markets, premiums are even higher. India is seeing 17% premiums. Europe is tight. Even wholesale dealers are struggling. This is proof the squeeze is real. Paper silver is trading at 67. Physical silver is selling for 75 or more. That spread is the market screaming, "We don't have enough metal." If you wait for confirmation, if you wait for the mainstream media to cover this story, you'll be paying $100 an ounce for metal that costs $70 today. Act now or pay later. Mining stocks are the leveraged play. If silver goes from 67 to 100, a well-run miner could see profits double or triple. But there's a trap here too. It's called the hedging book. Some miners, scared of price volatility, lock in future sales at fixed prices. They hedge. Imagine a company that sold 50% of next year's production at $35 per ounce. Silver is now at 67. They're still selling at 35. The banks keep the difference. Their stock will barely move. You want unhedged miners, companies that sell every ounce at the market price. You can find this information in their quarterly reports. Look for the section on hedging and derivatives. If you see forward sales, avoid them. You want 100% unhedged exposure, and you want primary silver miners. Most silver comes as a byproduct, so a copper miner might benefit slightly, but a pure silver miner benefits massively. Companies like First Majestic Silver, Pan American Silver, or Junior Explorers with high-grade deposits. Do your own research. Check their balance sheets, check their jurisdictions. A mine in Canada or the United States is safer than a mine in a politically unstable country. And remember, mining stocks are volatile. They can double in a month or crash 20% in a day. Only allocate capital you can afford to lose. Timing is everything. Right now, we're in the calm before the storm. It's December 21st. Markets are closed for the weekend. The lease hasn't expired yet. China's restrictions haven't started. The LBMA rule hasn't taken effect. The Sunday night futures open will be the first test. Asian markets open at 6 p.m. Eastern on Sunday. Watch the Shanghai Gold Exchange Premium. If silver in Shanghai is trading $5 or $7 above COMEX, that's a signal. Arbitrage traders will buy COMEX and sell Shanghai, forcing the COMEX price higher. If Sunday night gaps up to 68 or 69, the Friday smash was fake. The Asian buyers are front-running the January squeeze. But even if prices dip early next week, don't panic. Volatility is the weapon they'll use against you. They want you stressed. They want you watching the ticker every 5 minutes. They want you to sell out of fear. Don't. The fundamentals haven't changed. The deficit is real. The lease is real. The restrictions are real. A $3 pullback doesn't change physics. Let me tell you what happens if JP Morgan defaults. If they can't deliver the 128 million ounces, confidence in the entire paper silver market evaporates. Futures traders will demand delivery en masse. COMEX will be forced to either pay massive cash settlements or halt trading. If they halt trading, the price discovery moves to physical markets, coins, bars, and over-the-counter deals. The spread between paper and physical could hit 20 or 30%. At that point, the paper price becomes relevant. The real price is what you pay to get metal in your hand. And that price could be 100, 150, or higher. If JP Morgan does deliver, but only by draining the last of the COMEX vaults, the signal is just as bad. It tells the market that the vaults are empty. The next buyer who wants delivery won't get it. Either way, January 2026 is a turning point. This is when the paper game ends, when the physical game begins. Some of you are skeptical. You think this is hype. You think the system will find a way. You think the banks always win. Maybe. But ask yourself this. Why is silver at $67 if everything is fine? Why are COMEX deliveries at record highs? Why are Indian refiners sold out? Why are premiums spiking? Why did lease rates hit 40%? Why is China restricting exports? Why is the LBMA changing bar standards? All of these are facts, verified, documented, published by official sources. The COMEX reports are public. The LBMA announcement is on their website. The Silver Institute's deficit forecast is published. Indian import data is from their Commerce Ministry. You can verify every single claim I've made. This isn't conspiracy. This is data. The data says the silver market is breaking. You can choose to ignore it. You can choose to wait for CNBC to tell you. But by then, the opportunity is gone. The psychological warfare starts now. Next week, you will see wild swings. Silver might jump $5. It might drop $5. The goal is to shake you out, to make you doubt, to make you sell. Don't. If you own physical silver, it doesn't matter if the price drops to 60 or 55 in the short term. You're not trading. You're holding a scarce asset in a deficit market. If the price drops and premiums stay high, the drop is fake. If dealers are sold out at 62, but the paper price says 58, which price is real? The one where you can actually buy metal. Trust the physical market, not the paper market. And if you're waiting to buy, don't wait for the perfect entry. You'll never catch the bottom. Dollar cost average if you must. Buy some now, buy more if it dips. But get exposure. Because once January hits, once the lease expiry becomes public, once the defaults or squeezes make headlines, the price won't come back down. Let me give you the timeline. Today is December 21st, 2025. 11 days until January 1st. That's when China's export restrictions take effect. That's when the LBMA bar rule takes effect. The JP Morgan lease allegedly expires in early January. So let's say January 7th or 8th. That's 17 days from now. In 17 days, the trap springs. If JP Morgan secures the silver, prices might stabilize briefly before the next wave of demand. If they don't, chaos. Either way, the January 1st regulatory changes alone will tighten supply. The Shanghai premium this weekend will tell us a lot. If it's elevated, it means Asian buyers are positioning. If it's normal, maybe the market is still asleep. But I doubt it. Too many smart players know this story. Too many institutions are watching. Here's what I think happens. Sunday night. The futures market opens at 6 p.m. Eastern Asian algorithms will scan for arbitrage opportunities. If Shanghai is trading at a premium, buy orders will flood COMEX to capture the spread. The price gaps up, maybe to 68, maybe to 70. If that happens, the Friday close at 67 was the floor. The bull run continues. If the price opens flat or down, watch the volume. If it's low, it's just weekend lethargy. If it's high, someone is capping the price. But caps don't last in a physical shortage. By midweek, reality reasserts. By the end of December, we'll know if the COMEX can survive the delivery onslaught. And by mid-January, we'll know if JP Morgan can deliver on the lease. Let me repeat the opening. They told you silver was just another commodity. They told you the rally was over. They told you to sell at $62 and take your profits. They lied. Not a small lie. Not a white lie. This is a lie so massive, so deliberate, so criminally negligent that when the truth finally explodes into the mainstream, the entire global financial system will shake. While you were watching the ticker on Friday, December 19th, while the algorithms were painting charts and the talking heads were calling tops, something happened in the vaults of the world's largest banks that changes everything. J.P. Morgan Chase just got caught in a trap. A trap so perfectly designed, so precisely timed, so mathematically inescapable, that by early January 2026, they will face a choice: pay any price for physical silver or default on the largest precious metals lease in modern history. The banks are playing a paper game. China is playing a supply game. India is playing a demand game. Physics always wins. You have 11 days until the regulatory traps activate. You have 17 days until the lease expiry. You have right now to decide if you believe in the data or the propaganda. $67 is not the top. It's the starting line. Price discovery has begun. The suppression has failed. The vaults are empty. The deficit is real. And the squeeze is just getting started. This is not financial advice. This is a warning. Do your own research. Consult professionals. But whatever you do, don't say you weren't told. The silver bomb has been armed. The countdown has started. And when it detonates, the world will never look at silver the same way again.